economy consists of a number of markets. We have the product market, where we sell goods and services. We have the factor market, where we sell our resources that we use to produce those goods and services. So your natural resources we call land, labor, machinery, tools, anything that's been made and then gets used to make something else, so capital. All of that is sold in the factor market. We also have a financial market. So that's where we're looking at banks and we're looking at the money supply and interest rates. And then we have the foreign exchange market. This is where we are looking at our currency and the value of it compared to other countries' currency. And that's going to be, of course, related to trade. Well, we want to look at each of these markets, but let's start with the product market. And let's look at how it works, because once we understand supply and demand in a market, then these markets are very similar. We're just changing what we're looking at, but in all those cases, you have to consider supply and demand. So what do we mean by a market? So when we talk about a market, this is any mechanism that brings buyers and sellers together. So think about where you might go to buy something. Maybe you buy things at the mall, the grocery store, the gas station, Kijiji, online. All of these are markets, anywhere buyers and sellers come together. And so we have to consider that each of these markets consists of supply and it consists of demand. So when we talk about demand, we are looking at the consumers. When we're talking about supply, we're looking at the business. And it's these two markets coming together that is going to determine the price of the good or service in the product market. We'll look at demand and supply in the other markets momentarily. But this is what we call the equilibrium or market price. So let's look at how we end up there and where demand and supply come from. So let's start with demand. All right, so when we talk about market demand, demand is the relationship between price and the amount that customers or consumers are willing and able to buy. And we're looking at the relationship between the price and the amount the customers are willing and able to buy. So we're looking at how much are they willing and able to buy at each price. So essentially, this amount that they're willing and able to buy at each price is what we call quantity demanded. So amount consumers are willing and able to buy at a particular price. And we'll call this QD. Okay, so really we're looking at the relationship between price and quantity demanded when we talk about demand. So we draw a graph to represent that, and we have price here on the vertical, quantity on the horizontal. And we want to look at, as we change price, what happens to the amount we are willing and able to buy. So let's suppose, for example, that a can of Pepsi is, well, here's the question. How much are you willing to buy if a can of Pepsi, so let's say the price is $1. How many cans of Pepsi are you willing to buy? If we do it based on one person, then we're creating individual demand. If we do it on multiple people, then we're starting to look at market demand. Well, let's suppose that if a can of Pepsi is $1, then the amount that we collectively are willing and able to buy, let's say that amount is 50. Okay, so let's create a graph here, and let's go 1, 2, 3, 4, 5, $6 here for the price of the can of Pepsi. And here on our graph, we will go 10, 20, 30, 40, 50. Okay. We need these to be in equal increments, so the distance between 0 and 10 quantity is the same as between 10 and 20 to represent the fact that that's a change of quantity of 10. Same thing with price. We need the difference between 1 and 2 to be the same as the difference between 2 and 3 because those are both a change of $1. Well, if the can of Pepsi is $1 and collectively we are willing and able to buy 50 of them, based on how much we like Pepsi, based on our income, then we could put a dot right here. Now, if the price of a can of Pepsi, instead of being $1, is now $6, well, how many of you are willing to pay $6 for a can of Pepsi? Well, you like Pepsi, so maybe you want to have Pepsi, but now it's taking up more of your income that could be used for other things. So we know that when the price goes up, the amount that we are willing and able to buy goes down. So let's assume that at $6, that's too rich for most of us, that collectively now we are only willing and able to buy 10 of them. So here at $6, we're now at a quantity of 10, and if we connect those dots, this gives us the downward sloping demand curve. So this is the law of demand. It says that when the price goes up, the amount we are willing and able to buy goes down. And you already know this, right? This is common sense. When things get more expensive, you're not willing and able to buy as much. In economics, we take things you already know, we give them fancy terms, we give them fancy graphs, so when you explain things to people, you sound smart. So demand is downward sloping. Okay, we know that. When prices go up, the amount we are willing and able to buy goes down. Well, demand is all about the customer. What about the business? So let's look at supply. Okay, so let's define supply. Supply is the relationship between price and the amount that businesses are willing and able to sell. And when we look at this relationship, we're looking at the amount that businesses are willing and able to sell at each price. So here we have what is called quantity supplied. And quantity supplied is that amount that businesses are willing and able to sell. The amount that businesses are willing and able to sell at each price. So when we talk about supply, really we're looking at the relationship between price and quantity supplied. So we can graph this relationship between price and quantity supplied by putting price on the vertical axes and on the horizontal putting quantity supplied. And so now we have to look at how much the business would be willing and able to sell at each price. So let's go back to our Pepsi example. And in this case, we want to look at, okay, well, how much is the business willing to sell if the price is, say, $1? Well, this is going to be based on the cost to make a can of Pepsi. Well, let's assume that the cost to make Pepsi, let's assume that it's 50 cents to make a can. Okay, and we're just assuming this for simple math, which means the profit they're making on each can of Pepsi, $1 minus 50 cents, is 50 cents. So they're making Pretty good profit margin here. And let's say, okay, let's make our graphs match. 1, 2, 3, 4, 5, 6. And the quantity supplied here, let's just do a simplification. And let's do 10, 20, 30, 40. So yes, I know Pepsi makes millions of cans, but let's just simplify this into an easy problem. And then you can graph in the assignment your demand for Pepsi, and then we'll look at another problem with some supply numbers. So here, Pepsi's making 50 cents profit. That makes them happy. So at $1, there's a certain amount that they are willing and able to sell. And let's assume that that quantity supplied is 30. Okay. Now, what if the price of Pepsi goes up to $6? Now, we're assuming ceteris paribus. That is, nothing else changes. The only thing we're changing is the price. So we're assuming the cost to make a Pepsi is still 50 cents. So now the profit they're making is $5.50, right? Fantastic, huge profit margins. Makes Pepsi super happy. So now they're willing and able to sell even more at that higher price. So when the price goes up to, say, $6, maybe they are willing and able to sell 60 units. So when we look at the supply curve is upward sloping because the higher the price, assuming nothing else is changing, so ceteris paribus, nothing else is changing, the higher the price, the more profit they're making, the more they like that, the more they're willing to make more at that price. So the supply curve is upward sloping, and that's because when the price goes up, quantity supplied goes up. Businesses are willing and able to sell more. So when we look at the product market, we have a downward sloping demand curve and an upward sloping supply curve. It's where the two intersect that is actually going to determine the market price. Because Pepsi, well, they would rather sell a can of Pepsi at $6. Consumers, they would rather pay $1. Well, the problem is it's not based solely on the customer, because the business has to pay for its costs, it has to make a bit of a profit margin. So it can't be based solely on what the customer wants. And the business can't have solely what it wants, because at higher prices, we know that less customers are willing to buy. So if this is $1 here, and this is $6 here, we can see that at those two extremes, the amount that businesses want to buy doesn't match the amount that businesses want to sell doesn't match the amount that customers want to buy. There's a disconnect. So for example, here at $1, this would be our quantity demanded. Oh, my apologies. Here we go. Where's our little thing here? We lost our pencil for a second. Here is quantity supplied. So what we see is that quantity demanded is more than quantity supplied. Customers want more at $1 than businesses are willing to sell. So there's a shortage. And that shortage means that people are fighting over the last Pepsi at the store. And whenever there's a shortage, it drives the price up. Well, at the high prices, the amount that customers want to buy, that quantity demanded, is going to be much lower. But at $6, the amount that businesses want to sell, the quantity supplied, is much higher. If the amount that businesses want to sell, so quantity supplied, is more than customers want to buy, then we have a surplus. There's tons of Pepsi on the shelf. And how do businesses get rid of excess inventory? So if you have tons of Pepsi, how do you get rid of it? You put it on sale. And so where do we stop seeing this movement and change in price? It's where demand and supply intersect.